Did you know that even if insurance companies can sell surety bonds, these bonds are not considered an insurance product? We'll talk about that and every other interesting thing about your surety bonds today. What's up? You're watching Tito Talks Non-Life Insurance Discussions with me, your favorite Tito Miguel, who loves to make non-life insurance topics easier to understand for both agents and clients. Magandang Friday po sa ating lahat. Thank you so much for dropping in today to another one of our episodes. If you like this type of content wherein we talk about non-life insurance topics, feel free to leave a like and subscribe to my channel for more non-life insurance related content. Also, don't forget to watch the full length of the video until we get to our word of the day, wherein we're going to introduce another power vocabulary into your arsenal to make sure that you sound as sharp, as competent, and as authoritative as possible. Now, on to our main topic for today, which are surety bonds. Most agents are already familiar that there are companies that provide surety bonds for different types of scenarios, different types of cases. Most beginner agents are not familiar with what exactly a surety bond is and what it does. What they do know is that insurance companies have it and it is something that they can sell. And you may be sitting on a landmine or you may be sitting on a gold mine, sorry, if you are capable of understanding what surety bonds can do for your clientele, and if you do have the right contacts, you may be looking at a lifetime of loyal clients and regular commissions every time your clients do business with their own clientele. But the trick here is, it's to understand that surety bonds, although they're different from insurance products, surety bonds are only part of a larger network of business dealings that create a specific dynamic. So it's only a small part of a bigger picture. And that bigger picture is known as... Yes, that is the picture of suretyship. And the picture of suretyship is quite different from the landscape of insurance in a couple of other terms. The most prominent difference between suretyship and insurance is the fact that in suretyship, you don't have two parties, you've got three. That is right. There are three parties in a suretyship agreement as compared to insurance policies wherein you only have two parties, the insured and the insurer. That would be the insurance company. However, in suretyship, you've got three parties. But before we get to these three parties, it's important that we understand how this deal works. Because in suretyship, or you have suretyship, when one party, that is the surety, guarantees that another party, that is the principal, will perform a specific action without fail, which benefits another party, that is the obligee. So in short, this is a relationship wherein the principal, that's one party, asks for the help of the surety, that's the insurance company, to provide a guarantee to another party, that is the obligee, that the principal is going to perform a certain action. What type of actions are that, Miguel? Well, it can depend on whatever the obligee requires. It could be for completing a business contract, performing specific number of duties, paying off a loan, not escaping the country, or staying within the country, and any other thing that the obligee could require of a principal. And the surety is there to provide that guarantee. How does the surety provide the guarantee? Excellent question, Miguel. Sureties provide guarantees to the obligees by promising to indemnify the obligee for unfulfilled parts of the agreement between the principal and the obligee. Now, we're going to use one of the more popular types of surety bonds out there in the market, which is known as a bidder's bond. And we're going to go over that in slight detail. Usually, when investors are looking to set up large buildings or large commercial establishments, they don't have the necessary expertise and the manpower to complete such tasks. This is why they require the assistance and partnership of people known as contractors. Contractors, on the other hand, would like to partner up with these investors or these banks or these institutions in order to help them realize their construction goals. However, multiple contractors would want the same deal with the same investor or contractor or bank. So, what you end up here is with an investor choosing among different contractors which contractor they'd like to choose to help them build up their project. Part of what contractors obtain from sureties, those are insurance companies, are something known as bid bonds. And bid bonds allow the surety to guarantee to the investor, to the people who want to have the building constructed in the first place, that if they choose to go with that contractor who presented the bond, if ever that this principal does not fulfill their obligation, the surety will pay for the losses that the obligee will incur because of this failure. Kumbaga, sinisiguro ng surety na hindi papalya ang principal. Kasi pag pumalya ang principal, magbabayad si surety kay obligee. And that's it in simpler terms. Does this mean that you only buy surety bonds for bid bonds? Is that the only thing you can get? Not exactly, Miguel. This type of dynamic wherein the surety guarantees the performance of the action of the principal in favor of the obligee is just one of many types of the business dynamics to which bonds are applicable, or in which surety bonds are applicable. Certain obligees, such as government institutions, businesses, employers, could require bonds from their business partners or their employees, especially when their employees or their potential employees are dealing with sensitive materials, such as a business finances, such as a business's sensitive information, or the information and care of their clientele. So these businesses, these consumers, require bonds so that they have a form of guarantee na hindi sila lolokohin, hindi sila aabusuhin, at hindi sila iiwan ng mga kasosyo nila. So as you can see, anyone who's looking for a good guarantee in the business world can make use of certain types of bonds. What types of bonds are there, Miguel? Excellent question, and that's a question we'll have to answer in the next video, wherein we'll tackle the different types of bonds. In the meantime, when we talk about surety bonds, as you'll remember what we said earlier, surety bonds just form one part of this large dynamic, which means, and what I mean when I said that is that surety bonds are just one document in a part of three documents that connect all three parties in the event of suretyship. You have a contract in between the principal and the obligee. You have a contract in between the obligee and the surety. And of course, you have a contract in between the surety and the principal. And that contract in between the surety and the principal is known as the surety bond. So that means whenever a particular principal or person wants to get the guarantee of a surety provider, they would have to buy that particular bond from the surety. So when they apply or when they offer their services to the obligee, or when they complete or begin their contracts with the obligee, part of their requirements would have to be the bonds that they secured from the surety. So in a way, these three parties are connected by these three contracts in which they do create their businesses over. And the example about bid bonds that we explained earlier is just one, like I said, one of many different types of surety bonds that you can get for a specific number of purposes. And in the next video, we're going to talk about these different types of surety bonds and what you can sell to your valued clientele. Now, as we haven't forgotten our word for the day, and our word for the day, I hope you read this carefully. You're gonna have to explain this and mention this a lot. Is the word oblige. Yes, that is right. And the obligee is determined or is defined as the party in suretyship to which an agreement or performance of the action of the principal should benefit. Or in other terms, they are the benefactor of the performance of the principal or the fulfillment of the principal's obligations. In the event of bid bonds, once the contractor fulfills their end of the bargain, which is to create the building, the immediate benefactor of that created building would of course be the investors or the banks or the very, very rich people who want to have their building set up. So those people would be the obligees. All right? Now, although you have a G sound in there, it's going to go with a G sound, and the I is enunciated as it is itself. I, obligee. Hindi po siya obligee, hindi po sila obligee, it's obligee. And I hope you pronounce that with me one more time. Say it one more time for Tito. Obligee. With that being said, thank you so much for tuning in today. And I do understand we still have a lot to talk about when it comes to bonds. The next thing we'll be discussing are the different types of surety bonds. And you can catch that video right here. I hope I'm pointing in the right direction. You can catch that video right here. So once again, thank you so much for dropping by. This is your favorite Tito Miguel, always saying, I hope you enjoy the rest of your day.